So welcome back, everybody, to another webinar organized by Princeton for everyone worldwide. We're very happy to have Agustin Carstens with us today from the Bank of International Settlements. Hello, Agustin.
In Markus Academy has become a very famous academy.
Thanks. Thanks a lot for having you. And Agustin will talk about central banks and inequality, which is a very important topic, and he will highlight these two dimensions and how they're connected. Before we do that, I would like to say Agustin is, of course, the #1 at the Bank of International Settlements, which is the central bank of the central banks, and that's where every other month the main heads of the central banks meet. Before that, he was central bank chief in Mexico and also finance minister in Mexico. Before I give the floor to Agustin, he will deliver his speech and we have a Q&A afterwards. I will give some few remarks on the topics between monetary policy and inequality. And of course, the different types of inequality, one is income inequality and the other one is wealth inequality. And this chart just shows how the wealth share of the top 0.1%, so the super rich, essentially has changed over the last decades. That's taken from some lecture notes with my colleague Violante, which shows that actually, it came down significantly after the war and then it went up again since the 1980s. That's research from many researchers, including from Thomas Piketty and Emmanuel Saez and so forth. So when we talk about income inequality and wealth inequality, what's very important is if I look at an income profile over a lifetime, so let's suppose here's an academic who makes always the same income over his life, and there's some other person whose income is actually growing like a growth stock in a sense, is growing much more later in the time, then actually you might think they have the same wealth. So if you just discount the income, you might end up with the same present value of the income, so the same wealth essentially. But the question is all this wealth financialized? Some of the wealth you might not see because it's not traded and it's not seen, while the other wealth which is traded is very public and it's very visible in a sense. But more importantly, once this wealth is financialized or is traded, it is also very subject to interest rate changes. So for example, if these two income profiles will have the same present value under the current interest rate and you cut the interest rate, then actually future income matters much more than present income. And then the tech entrepreneur, here what I call tech entrepreneur, his wealth will go up a lot. So he will have a lot of capital gains. So the question is, to some extent, is the wealth inequality we are seeing, is it also partially due to the fact that we have now much more financialization of cash flow streams compared to previous decades? And the other question is it partly due to the fact that the interest rate is declining? There's a secular decline in the interest rate, and that's why we see some increase in wealth inequality. But more generally, we would like to understand, I think, how monetary policy redistributes wealth, and I've written a paper on the Jackson Hole paper in 2012. I presented it talking about redistributive monetary policy and focusing what we call, Julie Sanikoff and I, stealth recapitalization. It's a way to recapitalize certain sectors in the economy or certain parts of society if they're undercapitalized or close to bankruptcy. And how do you do that? You just change asset prices, and you might change some asset prices which are interest rate sensitive on the asset side of the balance sheet, and you also change the value on the liability side of the balance sheet. And if the interest rate sensitivity is different, but then actually you change the equity or the wealth of this particular entity. Can be a firm, can be a bank, or can be individuals, and it matters a lot how the assets are distributed in the economy. So for example, if like in Italy, people have a lot of houses, own their houses on their own, the average person, but has a lot of mortgages, then the interest rate sensitivity is very different compared to Germany, where most of the people save in savings accounts and they rent houses rather than own houses, and hence they don't have mortgages. So the implications of inflation and interest rate changes are very, very different. Now, what's the objective of monetary policy? And the two objectives you can think of, one is you might be wanting to stimulate consumption, and that's something where you actually redistribute among the consumers There are certain consumers who have a marginal propensity to consume, which is very high, that more the poor people, and some other very wealthy ones who have a marginal propensity to consume is very low. So redistribute from the low marginal propensity to consume consumers to the high marginal propensity to consume the consumers. And this way you manage aggregate consumption. So if your objective is for monetary policy to manage the aggregate consumption, that's what your emphasis on. It's about how you redistribute among the consumers across consumers with different marginal propensity to consume. That's, Jim Tobin and Auclair recently have worked on that. You can also stimulate investment by changing investment. You also then redistribute across investor classes. And by doing so, you change the risk premium and you also change the price of risk. And by redistributing, you might also change the endogenous risk. So you might make the system as a whole less risky, and by reducing the overall risk and reducing the price of risk, you change the risk premium, and by changing the risk premium, you change the discount rate or the discount factor, and this way you have a wealth effect. And the wealth effect then not only makes investment more attractive, stimulates the economy, but also makes people more wealthy, and that then leads to more consumption as well. So it also stimulates the consumption in the first place. And that's something, which is discussed in detail in these papers I've worked on. Now, let me just say, what are the two different channels? There are actually two literatures in macroeconomics, one focusing more on the consumption side, the other one more on the investment side. And one way to classify them is, one is, macrofinance, and the other one is HANK, heterogeneous agents New Keynesian models. So New Keynesian focusing more on the price stickiness. And in both settings, you need heterogeneous agents, because without heterogeneity, there's redistribution doesn't matter. If you want a representative agent, then wealth distribution is not really a thing to worry about. But one tradition follows much more the finance tradition, a la Merton, with a portfolio choice problem is at the center. The other one follows more the New Keynesian DSGE tradition, a la Woodford, focusing on that. And you can see that the different risks playing a role. So in the macrofinance thing, the risk plays a critical role. You have dynamical system, nonlinear systems, you have potential financial crisis to worry about, and you want to minimize the arrival of financial crisis. And the price of risk should not shoot up across various assets. You really want to control the flight to safety component. So the flight to safety aspect is really important in this branch of literature. The other literature, as I mentioned before, it's more the redistribution among the consumers to stimulate aggregate consumption. And you also have different assets, but they're not really, they're all essentially risk-free, these assets, but they differ in liquidity degree. And there's some you can easily retrade, others you cannot so easily retrade. And that's where the redistribution matters as well. And there's some more recent literature by Grecke and Lennell and Merkel and Zhang, who actually have both elements. They have the financial aspects to it and also the price stickiness components as well playing out. Now, that's, of course, focusing very much on the consumer and the investor. Of course, and then there's, of course, workers. The workers are also consumers. But what we see in the long run, the structural thing is, we see in the US in particular a decline in the labor share in the United States. So labor is getting less income. And within the labor sector, it is actually, when you see on these figures, you see an income, the top 85 to 95 percentile, their earnings are going up. That's the blue line. And the number of weeks worked is actually very flat. So they are not unemployed much. While if you look at the bottom 20%, you see from 67 onwards, that's a starting point. And the number of weeks worked is actually going down significantly. So people are really also unemployed, and the earnings are coming down significantly. And even the wage rate is going down. So not only the wage, but also the number of weeks worked is going down. That leads then to this blue line, which drops a lot for the bottom 20%. Now, what has monetary policy to do with workers' inequality in recessions? And it's very important that, to take this into account, that layoffs during the COVID crisis, for example, in the US, were much more severe for people who don't have a bachelor's degree. So 20% became unemployed during the COVID crisis, while with a college degree, only 12% became unemployed. And then there's also a slower recovery for lower paying jobs. So that's the resilience component. How easily can you bounce back? you're still unemployed in February 2021 if it's 20%, so 25 percentile, so lowest quarter, they're still unemployed. If you're in the top quarter, the highest quarter, only 6% are still unemployed. So it shows it's much harder to come back onto the feet. And of course, there's also a distinction between SMEs, which are run by minorities. They suffered much more during the COVID crisis as well. But more generally, the question is, how should monetary policy take these implications into account? First of all, I think what's very important is by just focusing on price stability and economic stability, you lower the crisis probability. Not only the probability of the risk premia, but also lower the crisis probability, the endogenous risk on its own. That helps the poor because the poor suffer the most from crisis I've seen there. And that's an inclusive argument, just doing the job right, focusing on price stability and macroeconomic stability. And then we have distributional effects, of course, and the transmission mechanism depends very much on the income and the wealth distribution, who holds what assets, what maturity of the assets, how is the housing stock held in the economy, how is it financed, is it with floating mortgages or fixed mortgages? All of this affects the transmission mechanism. And of course, the inequality then, monetary policy has some redistributive component to it. So with this, let me go to Augustin's poll questions. And his questions were essentially, how important are structural factors, for example, globalization, technology, labor markets arrangements, and so forth, in driving the rising trend of inequality? And the answers you gave us were primarily, fairly high. It was between 4 and 5. Almost nobody gave the low numbers. Most of the numbers gave 4 and 5. The second question is, which policy is best suited to deal with the inequality in the long run? And here the answers were fiscal policy with 33%, and monetary policy, nobody said that's essentially not the task of monetary policy, and 67% said structural policies are the important aspects. And the final question was, how high should addressing inequality be on central bank's list of priorities? And that distribution between 0 and 5 was pretty flat, tilted towards 0 and 1. So more, it should be lower priority, but it was flat. So there were some people who thought it should be not the low priority at all as well. So with these answers, I think I give up some food for thought for Agustin Carstens to tell us what his thinking is in this important topic. And thanks again for being with us and enlightening us in this debate, what central banks, how it is affected with inequality, and how central banks can affect inequality in both directions. So thanks. Looking forward to your presentations.
Okay, excellent. Well, thank you very much, Markus. Great to be with you again. So let me now share with you all my thoughts on how central banks can best contribute to a more equal society. Certainly, central banks are concerned about inequality. As public institutions, their end goal is to ensure economic conditions that support the well-being of all citizens. I will argue that over the long run, inequality is not a monetary phenomenon, though central banks' actions can have an impact on the distribution of wealth and income over shorter horizons. Prolonged periods of high inflation and recessions can hurt the economy and disproportionately hit the most disadvantaged. Therefore, the best contribution monetary policy can make to an equitable society is to try to keep the economy on an even keel by fulfilling its mandate. Governments can reduce inequality through more direct fiscal and structural policies. The nature and precise interpretation of central banks' mandates in this regard has evolved historically. These days, it is primarily interpreted as limiting business cycle fluctuations, measured in terms of output and employment, and delivering low and stable inflation. And low and stable inflation is rightly seen as a necessary condition to maximize output and employment sustainably over time. But there is another necessary condition for macroeconomic stability: financial stability. While most central banks do not have financial stability as a separate objective in their monetary policy mandates, changes in the business cycle have brought it to the fore. In a narrow sense, creating conditions for financial stability means mitigating the likelihood and severity of events such as banking and financial crises and the large output losses they bring about. But in a broader sense, financial stability relates to financial factors as amplifiers of business cycle fluctuations and as such forces that can stand in the way of achieving monetary policy objectives. For this reason, I will include financial stability under the broader objective of stabilizing economic activity. So let's start by looking at inequality trends. The graph in this slide displays the pre-tax and transfers Gini coefficient and shows that it has been rising since the 1980s. While income inequality has remained consistently higher in emerging market economies than in advanced economies throughout the period, it has seen a much steeper increase in advanced economies. The increase has not only been more modest in emerging market economies, it has even partially reversed over the last 10 years. My view is that the trend in inequality is largely the outcome of long-lasting and long-run structural forces, widely explored and documented in the literature. Among those, technological change, globalization, education, health, and institutional changes have played a major role during the past decades. These forces are largely independent of and insensitive to monetary policy, so the trends to which they contribute are best corrected by public policies, particularly fiscal policies. Needless to say, central banks are fully aware of the growing prominence of inequality in the public debate. Inequality is part of the environment in which monetary policy is set, and central bankers have to reflect in their decisions. For instance, rising inequality affects monetary policy decisions to the extent that it weakens the transmission of monetary policy. Households with relatively higher income and wealth typically have a lower marginal propensity to consume and tend to react to changes in policy rates. Less to changes in policy rates. Therefore, monetary policy has to act more forcefully to provide the same economic stimulus in a more unequal economy. Central banks' increasing attention to inequality is seen in this slide, which shows how the share of sample of central bankers' speeches mentioning the words inequality and distributional impact of monetary policy has grown over time. Notice that references to inequality are less common in emerging market economies. The reference to inequality in central bank communications to a large extent mirror concerns by some observers that by keeping interest rates very low and purchasing financial assets, central banks are creating conditions for income gain amongst those who already have a greater portion of wealth. Indeed, house prices and stock market indices has been rising since the GFC. One consequence is that households which hold more equity in their portfolios have made large capital gains. To be sure, this partly reflects the intended effect of monetary policy, as the higher valuations stem from an effective transmission of monetary policy. Yet the main losers are younger households, which may be increasingly excluded from access to property markets, and pensioners whose interest income on bond portfolio shrinks. These criticisms generally fail to cite the reason why accommodative monetary policy were deployed in the first place, to avoid a depression and then to support the recovery. The alternative scenario would have had markedly worse consequences for employment and inequality. This suggests that discussing monetary policy and inequality calls for a comprehensive approach. We need to consider the link between monetary policy and macroeconomic stability more generally, and do so against the context of policy mandates. Once we do so, it becomes clear that delivering on central banks' mandate of ensuring macroeconomic stability provides the best foundation for an equitable society. Let me now elaborate on why. In most advanced economies and increasingly in emerging markets, inflation has been low and stable over the past decades. Yet we should not forget the long-lasting scars of uncontrolled inflation on inequality. History abounds with episodes of high and runaway inflation that increase poverty and inequality via sharp reductions in real wages. The experiences of accelerating inflation, falling real wages, and increasing poverty in Latin America in the late 70s and 80s, and in Eastern Europe in the 90s are cases in point. Inflation is often rightly portrayed as one of the most regressive taxes. The households at the lowest end of the income spectrum are the least able to hedge against it. Their income is usually fixed in nominal terms and their savings held in cash or bank accounts. Indexation mechanisms where present offer only partial relief, as the frequency of wage adjustment often fails to keep pace, especially when inflation runs very high. Moreover, they tend to entrench inflation with all its broader economic costs. This makes inflation more likely to increase further and harder to bring down. Moreover, once inflation gets out of control, taming it brings additional costs. The necessary tightening of policy financial conditions brings on recessions and boosts unemployment, which disproportionately hit the most disadvantaged households. And the higher and more entrenched inflation is, the larger the cost. Just think of the US experience in the early 1980s. Now, once inflation is brought under control, the benefits become apparent. In many historical episodes, stabilizing inflation from high and volatile levels helps stimulate growth by supporting savings via higher real interest rates, promoting investment, and creating more and better paid job opportunities. The resulting economic prosperity meant income was more equitably distributed. The graph in this slide shows a comparison of 34 episodes of disinflation over the past 30 years, which mainly relate to the experience of emerging market economies. It illustrates that the conquest of inflation, here defined as bringing the inflation rate sustainably below 5%, has generally been followed by a decline in income inequality, as measured by the Gini coefficient. This may be one of the factors that helped abate the rising inequality trend over the past decade in emerging market economies. The other typical objective of central banks is sustained growth and economic activity, and low inflation is a means to that. Work remains the predominant source of income in society. Stable macroeconomic conditions that keep unemployment low increase opportunities for people to secure an income and sustain their living standards. As Jay Powell said in this webinar here at Princeton in January, maximum employment is a broad and inclusive goal which reflects the benefits of a strong labor market for many in low and moderate income communities. Indeed, unemployment tends to hit unskilled workers disproportionately and for longer. As recessions hit, the lower skilled workers are typically the first to be laid off. The pandemic is a case in point. As this graph shows, for European countries, according to Eurostat estimates, low-income workers are more at risk of losing jobs. For the most disadvantaged, the probability of losing their jobs can be up to 10% higher compared with high-income workers. Unfortunately, after a downturn, low-income and low-skilled workers also find increasing difficulties in re-entering the labor market as the economy recovers. Their qualifications deplete faster, and they may be forced to accept jobs paying less than they earned before becoming unemployed. This explains why unemployment has a persistent impact on income inequality, as shown in this graph. The impact of a typical fall in unemployment during recession is initially small, but tends to build up over time. A one standard deviation decrease in the unemployment rate pushes down measures of inequality like the Gini index or the share of income accruing to the top 10% by about 0.4 of their standard deviation. By keeping inflation in check and seeking to keep output stable, that is, recessions are fewer, shorter, and milder, monetary policy can play its part in promoting equitable growth. Yet changes in the nature of business cycles over the past decades are complicating its task. The first noticeable change is that the Phillips curve has become flatter for at least 2 decades now, as shown in this slide. Inflation is not just low and stable, particularly in advanced economies, but also less responsive to changes in the pace of economic activity. The challenge for central banks is that bringing inflation back up to target from below, where it lies in many countries, requires a more larger increase in economic activity and employment than in the last century. As a consequence, monetary policy needs to be more proactive for inflation to hit the target. The second major change is that financial factors have played an increasingly important role and have amplified business cycle fluctuations. This is illustrated in this graph, which shows the evolution of one indicator of the financial cycle, the credit to GDP gap, around turning points of the business cycle for both advanced and emerging market economies. Up to the mid-1980s, this indicator moved very little relatively to economic activity, but the most recent period featured large increases, which often coincide with turning points of the business cycle. Moreover, recessions in which financial factors play such a key role tend to be more severe, taking a larger toll on inequality. This is shown in these graphs, which compare normal and financial recessions experienced in 17 countries, including 4 emerging market economies since 1999. Here, recession is defined as financial if the debt-to-service ratio is unusually high before the start of each recession, which is normalized to ×0 in the figure. Overall, the data panel covers 24 normal recessions and 10 financial ones. Interestingly, 8 quarters after the start of the recession, the average output drop and unemployment increase are found to be respectively about 2.5% and 12% higher in financial recessions than in normal ones. This suggests that by contributing to financial stability broadly defined, even when not involving a banking crisis, monetary policy can help limit the incidence, depth, and duration of financial recessions. This fosters macroeconomic stability and in turn sustainable, inclusive, and more equitable growth. Changes in the nature of the business cycle have magnified intertemporal trade-offs and complicated central banks' job as they seek to deliver on their primary mandate. On the one hand, inflation low responsiveness to slack reduces the risk that labor market overheating takes inflation out of control, hence running a high-pressure economy and reaping the inequality benefits of a more inclusive labor market entail lower risks for price stability and greater benefits for income distribution. On the other hand, protracted periods of easy monetary policy may also fuel financial imbalances. This is challenging because as it reacts little to the economic expansion, the behavior of inflation conveys little information on whether the economy is operating above maximum capacity. It is also very difficult to gauge the accumulation of financial imbalances in real time. Such imbalances in turn may sow the seeds of a more severe recession and possibly serious financial stress and even a financial crisis down the road. The resulting downturn with bouts of unemployment can leave long-lasting scars in terms of inequality. Another relevant trade-off arises after the recession strikes, when monetary policy seeks to stimulate and nurture the recovery. Because of the need to work off the debt overhang, the central bank has to cut interest rates more aggressively and keep them low for longer, possibly alongside large-scale asset purchases. This necessarily eases financial conditions and sustains asset prices, which can disproportionately boost the wealth of the rich, adding to inequality. This is a temporary side effect necessary to ensure that employment is protected over time and income inequality is mitigated in the longer run. Let's not forget that the distributional outcome would would most likely be more dramatic without such action. The temporary effects on wealth inequality have to be compared with the consequences of inaction in terms of employment and income inequality. What do these complex trade-offs mean for monetary policy? They mean that other policies need to play a complementary supporting role to help foster sustainable growth. Monetary policy can do a lot to stabilize the economy, but it cannot do it alone. During the expansion phase, if inflation remains low and possibly even below target, a monetary policy focus on near-term price stability would naturally remain accommodative. During this phase, macroprudential measures can play a key complementary role. They can seek to slow down the financial expansion, especially in the sectors seen to raise the bigger risk for the financial system, often housing. Once the downturn sets in, it is essential that the banks be well capitalized in order to remain resilient, thereby containing the economic fallout. For that to be the case, macroprudential policy must have done its job. This is precisely what the post-GFC major international prudential reforms did pre-COVID, not least Basel III. This allowed banks to be part of the solution rather of the problem once the pandemic crisis struck. Still, banks may not be strong enough. The unwinding of financial imbalances and downturn may be so large that a financial crisis follows. The GFC is just the most recent example. At this point, monetary policy enters crisis management mode, with central banks acting as lenders and increasingly as market makers of last resort. But here again, central banks cannot succeed on their own. Fiscal backstops are essential to stabilize banks and the overall financial system, and thereby the economy. In addition, government intervention to help repair balance sheets is critical to resolve the crisis and set the basis for a healthy recovery. However, in this process, central banks may be criticized for supporting Wall Street at the expense of Main Street. But this is a false dichotomy, as central banks target broader financial conditions as a channel to limit the impact of the crisis for the benefit of the entire economy. The final phase is nursing the recovery, battling the headwinds of overhanging debt. A more balanced policy mix is called for to avoid some of the side effects of prolonged very low interest rates through asset prices on inequality and the economy more generally. This means more supportive fiscal policy and growth-friendly structural reforms to prevent central banks from becoming the only game in town. None of this, of course, addresses the long-term forces driving trends in inequality. Fiscal and structural policies too. And we should not forget that central banks can also contribute to a more equitable society by performing a range of non-monetary functions attributed to them by law. Fiscal policy is a good example of how powerful government policies can be, as it has the appropriate tools to mitigate inequality. The substantial impact of fiscal policy on income distribution is evident in this graph. For all advanced economies, inequality measured on post-tax income is lower than that measured on pre-tax income, for some substantially so. In Germany, a country with a relatively strong social safety net, the 2015 post-tax Gini coefficient is almost halved, falling to 30 from above 50. Structural policies are equally important. They set the foundations for a more equitable society by tackling some of the root causes of inequality. Think of all the impediments that set back the most disadvantaged: poor education systems, lack of access to healthcare, lack of competition, inadequate consumer protection, and poorly regulated labor markets. Part of the impediments to opportunities that I have just mentioned pertain to the financial system, and in some countries fall within the realm of non-monetary functions attributed to central banks by law. Many central banks have prudential responsibilities and thus play an essential role in maintaining bank resilience and ensuring financial stability. Others promote financial inclusion that, particularly in poorer countries, can reduce income inequality by boosting self-employment and growth opportunities. financial services consumer protection also shields the poor and more vulnerable from predatory lending, and together with policy supporting financial literacy from excessive risk-taking. Efforts to develop efficient and competitive payment systems help reduce overall costs, not least for cross-border remittances. And finally, fostering financial development increases the menu of options available to households to hedge and diversify risks. Let me conclude. Evidence shows that inequality is not a monetary phenomenon over the long term. Yet, central banks are fully aware of the consequences of their actions on income and wealth distribution over shorter horizons. While they do not have the necessary tools to achieve targeted distributional outcomes on top of their mandated objectives, they can go a long way in contributing to an equitable society by fulfilling their mandates. This means seeking to keep the economy on an even keel so that price, financial, and macroeconomic stability prevail. High inflation and recessions can be extremely costly for inequality. But keeping the economy on an even keel is not something monetary policy can do on its own. Moreover, changes in the nature of the business cycle, with the financial factors playing a bigger role, have complicated the trade-offs monetary policy faces. In order to address these trade-offs, other policies must play their part, notably prudential, fiscal, and structural. A balanced and comprehensive policy is those needed. Thank you very much.
Thanks a lot, Agustin. I have a whole list of questions I would like to bombard you with from this nice presentation, giving a big picture overview, covering all the aspects of inequality in central banking. The first question is about, from Pierre Korovsky. It's about small loans. In a sense, when you cut the interest rate and you benefit certain borrowers, some poorer borrowers don't have the FICO score, the credit quality to take advantage of that. Do you think there should be, taken into account when you conduct monetary policy that actually, you cut the interest rate, you help wealthy borrowers to refinance their mortgages, but you can't do this for less wealthy with a lower credit score? Is there any way monetary policy can do something, or that's beyond monetary policy and financial regulation to handle that?
Yeah, I mean, my sense is that that falls outside the real direct impact of monetary policy. I mean, of course, monetary policy is there if inflation is stable and so on and so forth. The likelihood of different forms of financial intermediation might start trickling down to those levels. But my experience in a country with where SMEs loans and so on are essential and are the need of a big part of the economy, I think that precisely structural policies are needed. Aspects like information. I mean, information is key in financial markets, and the availability of information is very scarce. To get information is difficult. To process that information is difficult. Transactions costs are very, very important. Collateral that they can provide is scarce. I think that here, for example, some fintech applications are powerful. And even though, for example, big tech have a lot of drawbacks from different points of view, but for example, in China, they have done a very good job in using the information they gather from social networks to substitute for collateral. And that has really made loans to SME far more available. So I think macroeconomic, yes, monetary policy, yes, provides a good basic environment for those loans to come to fruition. But I think structural policies are definitely definitely need to be addressed.
Thanks. So then, I very much like from your speech that you have these two components. You have the high inflation environment impacting somehow wealth inequality or income inequality. And then you're fighting the inflation if you want to get back to a more reasonable inflation environment, or taming inflation is actually also has impacts on the wealth and income inequality. So I was wondering whether you can elaborate a little bit further from your experience in Latin America and this, Peru and other countries which have suffered that. And in particular, you show the Gini coefficient, but my impression is, the middle class is suffering to a large extent from higher inflation. And to what extent can the Gini coefficient capture that? Because the Gini coefficient measures some inequality as an average over the whole population. But if you have somehow the middle class holding out and the top is very well hedged against high inflation, and the bottom is benefiting from higher employment levels, but the middle class is losing its savings, do we need more general inequality measures in order to capture, that it's not, we cannot summarize with one number like the Gini coefficient?
Well, of course, yes. I mean, definitely there are different indices that would enrich the information. I think what the point you raise is very, very important. I mean, if you consider emerging markets over the last 10 to no more, probably 20 to 25 years from, let's say, mid-90s, I think the big contributor to improving to some extent the income inequality and well-being of the population is the fact that the middle class has been increasing. And in a way, this calls for, and this reflects what I was mentioning in my speech, the fact that there are huge welfare gains of bringing down inflation. And an important part of that is just the fact that as inflation comes down and financial conditions become more stable, there is more loans, there is more credit intermediation. I mean, financial intermediation in Latin America compared to Asia is far smaller. And part of it is just because of this history of instability. Now, the other thing that we have learned, and that is also very, very critical, is that it takes a long time to really consolidate the change in the income distribution. I mean, a problem that we have been seeing recently in some emerging markets is precisely that as a result of COVID-19, which is it's a real shock. It's making some people that achieved the level of middle class to trickle down, to be pulled down again. And that is very sensible, and that's something that, of course, generates huge social and political problems. So, I mean, this calls also for relatively long periods of time for these better conditions to mature. And in particular, in what has to do with central banking and monetary policy, is to have a continuity of keeping inflation well anchored and financial stability ingrained. So it's a challenge. It's a challenge.
So one thing, if I may come back to a webinar we had just 2 weeks ago with Amy Nakamura, she was actually arguing the Phillips curve was always flat, while you have shown that actually Phillips curve was much steeper and then became more flat recently. And she argued, it is just distorted from the Volcker experience that people had to learn that the inflation is anchored and was not certain. Would you side on her side, or would you say, actually the Phillips curve flattened over the last few decades, especially in the US? Or would you say it was always flat compared to what she claims? What's your position? Beyond inequality.
This is the $64,000 question. No, my sense is that it has definitely changed over time. There's some structural changes that are there in place. I mean, I think that, for example, what has happened in the labor market, globalization and so on, definitely have had an impact on the Phillips curve. The GFC might also have had a major impact on the Phillips curve, and the real impact of COVID-19 might also have an impact. Now, the big question is, as for example, we enter into a more upbeat scenario where, you know, the economy is starting to gather speed, and aggregate demand is really being reflected in higher income. We're getting closer to full employment, and we're starting to see more inflation if those parameters will be stable. And that's the big challenge. Something that I think, at least talking as a practitioner of monetary policy in countries where we have ended up with higher inflation, is that the Phillips curve might not be all that flat all the time, and that at some point it might have a non-linear relationship. So I think it's something that we need to watch, no? But I'm more in the camp that through time, as these other real factors have been played out, have been affecting the shape of the Phillips curve.
Then there were some questions about international aspects. If you look at the inequality across countries, it came down significantly. So while inequality within countries went up, across countries it came down. And I was wondering, you know, whether that has some implications on coordinating monetary policy across countries. Of course, you know, now we have a much more common framework, and people, central banks think alike, more alike than I guess in previous decades. Do you think that's helpful, or has some implication in terms of international, if everybody is doing the same thing, at bringing international inequality down, or do you think that's much more to do with?
No, I mean, if you think in terms of changes in macro policy in the last 3 decades that have affected the most different countries, I would point out 2. One is the very broad-based adoption of value-added taxing systems. This is less distortionary. And the other is the adoption of inflation targeting. Now, it's not only the fact, it's not only the theoretical framework and the reasons why it works, but I mean, to do serious inflation targeting, as it has been done by many countries, it means that society recognizes inflation as a problem, and that is willing to endow an institution with the instruments to fight it, and to have an institution in society that will keep inflation down. And I think this really has made a huge, a very important difference. And I'm part of the believers that, you know, to bring inflation down helps not only protect income distribution, but also establishes the conditions for other real factors that tend to improve income distribution to flourish. So from my point of view, the fact that there has been, I would say, a broader recognition that bringing inflation down and keeping it down and stable has been a plus.
So I
would add to that too, the fact that financial stability has also been recognized as an important factor. I mean, if you see the degree of collaboration that there is internationally on bank regulation and standards for supervision, really is amazing. I mean, all the work that has been done around Basel III, but also adoption of those standards by countries that even do not participate directly in the Basel Committee of Bank Supervision, has been very telling, you know. Now, of course, financial markets tend to run very fast, sometimes to be very volatile, unpredictable. But by and large, I think that a lot of additional resiliency has been acquired by this international cooperation and collaboration of having appropriate standards.
Great. So let me ask you perhaps some aspects which, through the COVID crisis, many countries have a much higher debt level. And some observers argue the only way to get out of these high debt levels is some form of financial repressions. And that would come along with higher inflation and keeping interest rates low in a sense. Do you think that's in the current environment with, very developed financial markets, that's still feasible like it was feasible after the Second World War? And if it were to be implemented, what would be the implications for inequality? Which part of society would lose out? Would it be the middle class again? Or have you, thought about this? Or do you think that's anyway not a feasible strategy to go for financial repressions?
Well, I mean, certainly right now we're in a situation where there is a lot of coincidence of objectives between fiscal and monetary policy, and in a way you can explain and understand the increasing debt, given that right now we have nominal rates at the lowest level in the last I don't know how many years. So I think that makes it relatively attractive to engage in more debt, and needless to say, the magnitude of the shock that we experienced is a good justification. Now, as we move forward, and right now also the objectives of monetary policy has been supportive of what fiscal policy has been doing. But we need to be frank and realistic. At some point down the road, this coincidence might not be there. And my point is that the monetary policy will have to not lose its eye from its key mission, because also at the end of the day, it would just make life more difficult. And down the road, some form of normalization in fiscal policy will also have to take place. Now, I think that there are long horizons for this to take place. It doesn't need to be sudden. It doesn't need to be abrupt. But in the future, governments will have to be judicious, and they will need to be opportunistic. That at some point they will have to mind these aspects. The other thing that is very important is not only to concentrate on traditional macro stabilization policies and try to anchor a long-term growth strategy based only on fiscal and monetary policy. I think one of the problems that we face in our profession is that probably we don't talk enough about structural policies, no? And I see with good eyes that in some countries, there is this intention of support and complement more traditional macro stabilization policies with structural policies that at the end of the day will enhance the capacity of growth of countries. If we grow more, also the debt issue will not be such a tough issue.
So let me come to some political economy questions. So Patrick Honor would like to know, if central banks get more involved in inequality issues, are they vulnerable to reputational damages and political economy pressures in a sense? And how would you guard against that? And, is this an issue? Or do you think central banks shouldn't get into this space anyway beyond the points you outlined in your speech? And hence it's not.
Well, I mean, I hope that my message was clear. I mean, I think that yes, central banks have to mind the issue. Central banks cannot act if this were not happening. Central banks need to respond to the needs and the demands of society. But central banks have to be realistic, and they have to be honest in terms of what can they produce. No, my sense is that what they can produce is what their instruments allow them, and that is aligned with the mandates they can comply. And what I hoped I showed in my presentation is that those mandates are very well aligned with helping to have a more equitable society. And there are some aspects that we also already discussed that are, let's say, when the central bank wears its non-monetary hat, that can have also an important impact on opportunities. Not all, not extremely powerful, but in some countries to have a more financial literacy, to have more inclusion, and so on and so forth can make a major difference. So yes, we can pitch in. Yes, we should be involved. We should join the battle. But again, in this particular aspect, we cannot be the only game in town.
So then you pointed out in the speech very nicely how important it is for central banks to get, stabilize the situation even after a recession or financial crisis, avoid a financial crisis in the first place. And if it happens, to stabilize the situation, because it helps essentially the labor market and then it helps the poor. I was wondering, when we look at wealth inequality and income inequality, whether, in particular in the wealth inequality side, we ignore the labor side too much because we don't have good measurements of discounted future labor income. And it should be part of the wealth inequality measures in order to fully reflect that. Do you think there's a measurement issue and we should develop some tools to measure, future discounted labor income and put this in our wealth measures as well in order to have the right incentives to make sure that, it's reflected in the numbers, in the statistics, and hence we fully incorporate this important aspect as well of inclusion?
This is a very challenging, a very interesting question. I think you're right. We need to deepen our understanding of these issues. I think one aspect we need to be careful, though, is that some way of bringing this forward is through financial markets. No, I mean, let's say if you go if you have a very encouraging future flow of income, and you go to a bank, you might get a loan for your house, and you will accumulate wealth through time. No, so if you will have already in your asset side there those assets, and I think that's one of the roles of financial markets. No, precisely to reflect that. Now, I think we will need to be careful about considering those type of issues.
So let me conclude with a final question, which is, more for researchers and PhD students. So you identify with inequality in central banks a very important topic. Do you have any advice for the researchers attending here and PhD students? What aspects to work on? Should they focus on this topic? Is this a primary importance for central banks down the road? And are there particular areas where you would say, oh, that's what they should really pay most attention to? Or is it, financial inclusion and other aspects? Or should they focus more on the structural and the fiscal side, because you think this is more where the action is to fight inequality?
Well, I think that a very, very important challenge that we all face, and that it will be great for us to have a much better information, because I think it can change many things, is how technology is changing the real sector of the economy, and how technology. I mean, for example, a lot of what you're showing there in terms of the impact of income distribution in the last years is precisely because of structural changes in the economy. And many of them is related to technology. I mean, the change in e-commerce, the fact that now, we can talk like this very nicely, me in Basel and everybody else in the Americas. I mean, that would have taken a trip and many hours and so on and so forth. It would have been great to be in Princeton, but this is the best we can do today. And but that has real effects, no? So for me, I mean, if you ask me, one of the things where I would definitely like to have more information, more research, is how technology really is changing the realities in which we act. And for central banks, I mean, obviously, we act in the context of reality. And if we understand reality better, you know, we will be able to do our job better, no? And this applies also for inequality. I mean, obviously, it's part of the equation, even though we don't have many direct instruments to address it. But it also has incidence on that. So for me, that is a key aspect.
Okay, thanks a lot. And then, of course, there's the whole payment technology, which is changing too. And the BIS has worked a lot in the Innovation Hub. And that's one aspect which probably will touch on inclusion and inequality as well. So I'm very grateful for your presentation. Thanks a lot. And we stay in touch, hopefully. And hope to see you soon, hopefully in the real world again.
Absolutely. Thank you very much, Markus. Thank you. Bye-bye.
Bye-bye.